Hi everybody and welcome back to the Local Show. So today we're going to be looking at 10 different reasons why it may be particularly risky over the coming years throughout the 2020s to be overly exposed to housing markets. This is not to tell you to sell your home or anything like this, but it is more just to give you some food for thought as to different factors which may impact the value of housing locally and around the globe, frankly, over the coming years. Now, we will go through 10 quick points as to why things may take a trip down south over the coming years, and then we'll finish with a bonus point. But before we get to that, we must quickly understand historically what is it that drives up and has driven up house prices over recent years and recent decades. Now, there are 7 bullet points here. They are all interlinked somewhat, so I can't really talk about one without talking about all of them together. So effectively, any scarce resource, say a house, if the supply is constant and there is an increase in demand, the value, the price of that asset will go up. So anything effectively that is increasing demand has, to this point, led to an increase in the value and the price of homes. Reduction in unemployment, i.e. high levels of employment, help fuel this demand. So until March, whenever the first lockdown happened, we were in a scenario where levels of employment were basically in and around all-time highs. As a result, more people were able to go to their banks and say, look, I've got this monthly salary coming in, here's my proof of income. Would it be possible for me to borrow money in the form of a mortgage in order to avail of this house purchase here? And the banks would say yes. And credit has been, up until this year anyway, it has been more easy than it has been historically to avail of that credit. So you're in a scenario where banks are more willing to lend and more people have been employed than ever before effectively. So that those 2 points coupled together led to an increase in demand and an increase in capacity for people to get on the property ladder. Now, younger generations obviously have had different challenges in getting on the property ladder because housing prices have been so high compared to historic norms. But the fact that banks have been more willing to lend and the fact that more people have been employed are 2 reasons which have driven up the price of homes. In addition to that, now this isn't something that has actually happened, but one other potential driver of increase in house price value would be a reduction in income taxes or just taxes for the everyday person, as that would lead to people having more disposable income. Now that's not something that has happened recently, but the inverse of this we will discuss later as in the future of taxes, because an increase in taxes will effectively reduce the capacity of people to be buying homes because it will reduce disposable income. Okay, interest rates. So a reduction in interest rates will effectively, and always has historically, meant that you have to pay back less in terms of a percentage basis on the mortgage loan which you have borrowed. So we'll get to this in a minute, but we're at all-time lows in terms of the base rate of the Bank of England. They have data for over 300 years, and where the interest rate as of today is lower than it has ever been. So this constant, like every time that the interest rate has gone down, this has been a way of fueling more, demand in terms of more people have more access to easy credit while they're employed at a lower mortgage repayment. And as a result, there's more demand for housing. As a result, prices go up. Strong stock market. So yeah, just in general, we've now, the bull market, and a bull market is a market which is going up effectively in time. We're approaching the end. Well, it's been volatile since the start of March, but we're effectively at all-time highs. And if you go back to the lows of 2007, the bull market, the stock market that we've been in, this bubble, this reinflated bubble over the last decade plus, is effectively the longest bull market in history. So whenever there's a strong stock market, in theory, people across the board, not everyone obviously, but will have, in theory, more in terms of their net assets, their net worth, their disposable income, in theory is high. So whenever the stock market is strong, there is more buying power, which again can help stimulate more demand for housing because people have more money. And lastly, I've gone on a funny order, but government schemes. So recently, because it has been difficult for people of younger generations to get on the property ladder, there have been a number of government schemes which have temporarily further stimulated demand in terms of help to buy ISAs and co-ownership schemes, and even more recently the stamp duty, the removal of the stamp duty tax that you have to pay on housing. That was removed during lockdown, which pushed up prices yet again. So we're in a funny scenario where house prices are effectively on a par with where they were, if not slightly higher, at the peak of 2007, before the Great Recession then. So you must ask yourself, one, have house prices recovered? So initially in 2007, we had this bubble created before things burst. So you have to ask yourself, are we in a scenario now where house prices have recovered to the peak of that bubble, or has the bubble reinflated and we're just in another bubble? So yeah, this is historically what has led to house prices increasing. Now we're going to look quickly at what I envisage will lead to house prices decreasing over the coming years. The first point is a little complicated, then everything will be swift and pretty straightforward. So leveraged trading, what is that? So if I'm to buy shares in a company, say I have £1,000 and I want to buy £1,000 worth of shares, I can just directly buy £1,000 worth of shares. What else you can do these days is you can engage in leveraged trading. So a number of different exchanges will give you the facility of engaging in leveraged trading. And what that is instead of buying £1,000 worth of shares, I can put down that £1,000 as a deposit, and that exchange will give me funds. They'll charge me an interest rate for it, but they will give me funds to the value of as much as 10 times my initial deposit, with which that I can effectively bet on the value of the shares going up or going down. So if I bought a share at £1,000 and that share value went up, that company's value went up by 100%, say it doubled, my £1,000 would then be worth £2,000. However, if I say did a 9 times leverage on that share and did leverage trading instead, that would mean that my deposit is £1,000 and they give me 9 times more that I can use to leverage trade. So that'll give me a total of £10,000. So my initial £1,000 deposit is now £10,000. So if the value of that company doubles, instead of me going from £1,000 to £2,000, I'm now going from £10,000 to £20,000. Massively, because the benefits of leverage trading on the way up mean that you gain exponentially on the way up. However, right, if you're in a scenario where you've done that, so your £1,000 deposit's down, you've done a 9 times leverage trade, and you now have funds of £10,000, if the value of that share, if the value of that company goes down by 10%, you then experience the inverse impact of leverage trading. So in that scenario, if it fell by 10%, the £10,000 value that you're dealing with will have fallen down to £9,000. And in that scenario, in leverage trading, because your 10,000 has gone down to 9,000, and because your deposit was only 1,000 in the first place, you've been wiped out, because your £1,000 deposit is now liquidated and the exchange will close your position. So in leverage trading, what you have is an increased capacity to make money. You can really benefit if things go your way. If they go up and you're betting on the thing going up, you're standing to gain so much more than you would have if you just bought shares, because you're playing with so much more money through the leverage of the exchange funds that they're giving you. Now, if I was to tell you that I was going to do that with shares, or if I was saying, would you be interested in doing that? You would say, no, that sounds incredibly risky. Obviously there's massive upside potential there, but I just don't have the capacity to lose that, £1,000 in the first place. I'd much rather just play it safe, maybe buy shares without 1,000 and see how it goes. Now, that's complete fair comment. The problem is if you substitute the word share with the word house, both in theory are assets, but that's exactly what you're doing if you're getting a 90% mortgage. So if you think about a more normal scenario in terms of home ownership, if you want to buy a house that is £200,000 and you've been able to get together £20,000, say a 10% deposit, that means you have a mortgage of £180,000. Now, if the price of that house goes up by 10% in value, because you have effectively opened a leveraged loan position in the name of a mortgage, the 10% increase in that house value will move your house from 200,000 to 220,000. So your initial £20,000 deposit, if you sold the house now, would be worth £40,000. You'll have doubled it because you've gained the enhanced benefits of the leveraged trade loan, which is your mortgage. And people don't and the problem is because house prices go up or have gone up to this point over recent generations, people don't realize, even though ask anyone that got burned in 2007, 8, 9, they'll tell you all about it, but the nature of a leveraged loan is, while it's incredible whenever it works in your favor when things go well, it works equally proportionally negatively when it goes the other way. So if house prices were to fall by 10%, your £200,000 house would be worth £180,000. You would still owe £180,000 to the bank. Say house prices fell by 20%, your £200,000 house would now be worth £160,000. Your initial deposit was 20, right? Your house is worth 160, and you still owe the bank £180,000. So if there was a scenario, and there may be a scenario where there is a significant move down in the value of housing, if you have a really, really, really ambitious mortgage where you're stretched as it is now, things could potentially get bad if there was a scenario where house prices fell in value a lot. And then also you need to consider other things, especially with the uncertainty of the economy at the moment, in terms of, will I always have the capacity to pay off the mortgage repayments? Will I have the motivation to do so if I'm making these repayments on this loan that's substantially higher than the value of my house? So these are the things you need to think about, and this is what owning a mortgage is. You're effectively engaged in leverage trading, but because it's so normalized, because everyone does it, people don't typically seem to realize what it is that they're potentially getting what it is that they are getting themselves into, and the potential negative impacts of doing so. Okay, I'll keep this short, so I'm going to fly through the other points. Interest rates. UK base rate, the Bank of England base rate, the minimum lending rate of the UK. So the way it works is the Bank of England can provide a normal bank with a loan, and then the bank provides you and I with that loan. And the minimum lending rate of the Bank of England for the last 300 plus years, you can see data, you can get it up in the computer in 2 minutes. It actually shows you data of any changes to the base rate, the Bank of England base rate, since 1694, incredibly. But the average interest rate in the last 320 years has been 6%, right? 6%. The lowest that it has been in the last 320 years was 2% briefly in 1932 and briefly in 1939. 2% was the lowest in over 300 years until 2009. And from 2009, for the last 11 years, we've been in a scenario for the first time in history where the base rate, the minimum lending rate of the Bank of England, is less than 1%. And as of March this year, it has gone lower than it's ever gone before. We're at 0.1%. Now, as we mentioned earlier, anytime that the interest rate is reduced historically, because this means that more people can, or people can avail of lower repayments in terms of the interest that they're paying on it is lower because the base rate, the interest rate is lower to begin with. That has historically fueled an increase in demand. Now, we're in a situation now because we're at 0.1% where the Bank of England doesn't have the capacity to move it any lower unless we move into negative interest rates. That's something that's never been done before in the Western world. And, well, your guess is as good as mine in terms of how that would unfold in terms of housing. But what you can see here is that we're in a really unprecedented time in history in terms of the fact that we're at a lower interest rate than ever before. So that lever, that ammunition that central banks have had to stimulate further demand for housing over centuries is in a situation now where there's effectively no more room to push that any further. And if and when the interest rate eventually returns to historic type, i.e. something like 6%, that will mean that mortgage repayments are much higher, which will reduce demand substantially for housing and will have a knock-on impact surely in terms of housing value. Okay, demand, commercial property. Don't know if you've noticed, but if you go around wherever it is you're living in terms of cities and things like this, commercial property businesses are empty. People aren't using them. People are working from home. People are being forced to close down. All sorts of jazz like this. So, right, I've worked for 5 roughly of the last 10 years off and on in Dublin. Dublin, Ireland, if you're watching this video from further afield. That is a prime example of a city where people have flocked to it in recent years because there are jobs there, because the commercial property there is buzzing with all sorts of businesses, all sorts of offices, and as a result, people are going there. And whenever people go there, what do they want to do? They want to live there. So as a result of that demand, house prices in Dublin and cities like that have gone through the roof because there's such a constant influx of new people coming there for more jobs because they need to be there for the higher paying jobs that they're seeking. As a result, that historically has pushed up the price of commercial property in these big cities. But now there is serious uncertainty in terms of the future demand of commercial property in cities or anywhere effectively. I'm actually going to skip a couple and link that with remote working. So obviously there has been a necessity to do more remote work over the last few months, but with technological change and cultural acceptance of this, we're getting to a stage now where there's going to be much more remote working. So if you look at cities in particular where they've had this historic demand in terms of employment, with people going there to work, that demand isn't necessarily going to be there in the coming years. As people start to work more remotely, they may think, wow, I can move to a more rural location, I can go somewhere where things are cheap, and as a result, all the places that were historically, buzzing in terms of demand, they may not have that demand anymore. Prices could, as a result, go down. Link this with unemployment / business closures. So although there are still loads of different schemes, furlough schemes and things like this, the reality is that eventually all this money printing will come to an end. As a result of all the money printing, there's going to be crazy inflation, and there will be more negative impacts down the line. You can look at my previous video on money, inflation and the destruction of the middle class, which I'll link below this video. But there will be increasing difficulty for more businesses over the coming months and years, and unemployment has already started to massively increase from the all-time highs effectively at the start of March before lockdown started. So these are things which are going to make demand, reduce demand in terms of housing, because if more businesses are closed, less people have more disposable income, more people are unemployed, less employed, they can't then go to banks and ask for mortgages. So that again reduces the demand for future home ownership. Government schemes. Okay, so we've had the Help to Buy scheme, we've had the co-ownership scheme, we have had during lockdown, because listen, house prices started to fall, but then what they did in the UK anyway was they removed stamp duty. So that was another way of bolstering demand, artificially short term. They've already used that, so you have to ask, and this is kind of a big one, because it's for me it's a really bad thing how we're moving towards this big centralized, inefficient government, controlling everything type world at the moment. This push towards globalism and things like this, but I don't. You have to ask yourself, in terms of government schemes, well, they've already run out of the ammo that they've already used to bolster inflation or to bolster demand short term, in terms of all these different schemes to try and get people on the ladder. Will they continue to do all sorts of crazy, wacky schemes? Most likely, but at some stage, people's mass psychology will shift from irrational exuberance in terms of the housing market to reality and then panic. So, government schemes, will they do more? They'll need to, in order to again, short term, keep things bolstered. But will they? Probably. Will it work? Maybe short term, but something to think about. Impact of stock market crash. Okay, we're in a scenario where the economy in real life has been dismantled over the last 6 months, yet stock markets are approaching and passing in some areas all-time highs. For a number of different reasons, you can look at my previous videos. Look, there's going to be a major stock market crash in the next few months, in my view, as a result of all this money printing and things like this. And just ask yourself the impact of a stock market crash. So we haven't had a proper one, like as bad as the last recession, in 11 or 12 years. So if in the event there is a stock market crash, what will happen in terms of people's... So as we alluded to last week, a lot of people have workplace pensions, and the composition, the default composition of a number of workplace pensions is something like 60% built into the stock market. I'm going to do, incidentally, my next video will be specifically looking at workplace pensions. So with workplace pensions are built into the stock market, and a lot of people's net worth in general is built into the stock market. So that's something to consider. If there's a crash in the stock market, how's that going to impact housing? Supply greater than demand. Okay, so if I think of my city, and I would encourage you to think of yours right now, have there been numerous new build estates built over the last 2, 3, 4, 5 years? Constant new build, new estates. People are moving into new builds left, right and centre, I would imagine. And then ask yourself, is the population of my city increasing in equal proportion? And I would hazard to guess that in most scenarios, the supply has been a lot greater than, in terms of the amount of new build estates that have been made, has been a lot greater than the increase in population. And that has been as a result of the fact that credit's been easy, employment's been high, interest rates have been low, and all these things. So we're at a stage now where supply is like really high, and it's arguably higher than demand. And demand, for all these reasons, is going to fall. So whenever you start to get to a stage where supply is massively outstripping demand, prices are going to go down. False 10th point, false generational narrative. So this is the unfortunate thing. Look, if your parents are giving you advice, or your grandparents are giving you advice, they're just going to tell you what they've known in their lifetimes. So house prices have literally gone up, off and on, but for the most part up, since like home ownership became a mainstream thing from, 50s, 60s, 70s. As a result, people have this artificial narrative in their head that house prices always increase over time. And unfortunately, that's not how financial markets work. Whether it's cryptocurrency, whether it's stock markets, whether it's precious metals, gold, silver, palladium, platinum, whether it's commodities like oil, whether it's anything, housing is no different. Government can throw everything that they want at this problem to try and keep this silly bubble going as long as they want, but eventually things will go the other way. And housing is just a very slow moving, elongated bull market, but we're approaching the very end of that. And whether or not the government are able to do different things to artificially stimulate that demand for another 1 or 2 years, potentially. But at some stage, what goes up must come down, you know, and for all these reasons, there is serious logic to suggest that demand is going to fall. Capacity to continue getting on the housing ladder is going to fall, you know, disposable income is going to fall. So these are all things to think about. Bonus, last thing, toxic social media and perception of security. So everyone's heard that term, keeping up with the Joneses. If you know, back in the day, what it would be is some family at the bottom of the street had some nice car, and you might overstretch yourself in the scenario where you're you know, getting some car lease or something like that to try and also get the nice car. Keeping up with the Joneses. Now, what we have had in terms of toxic social media, we're in this scenario where you can literally see the Joneses anytime you look at your phone. You can load it up and you can see the lifestyles of the rich and famous. You can see people in your community, in your friend group, whatever it is. And people have started doing this thing constantly now, and it's unfortunate to see, but where it's like they're holding their keys, you know, happy couple holding their keys at the front door, as if it's like, look, hashtag adulthood, you know, not realizing that you're kind of, because someone else will see that then being like, oh God, I need to do that, or I haven't, you know, leveled up yet. But because of all these reasons, people don't realize that, and this ties in with the other point here, that you're potentially getting yourself into a position where you're overexposed to a market which may go against you aggressively in the coming years. And I'll link this in with false perception of security. And the two need to be linked, although it's not a very nice point to make. So, physiologically, biologically, at least, you know, initially, men typically like women based on attractiveness and youthfulness, and women typically stick and go for men because of perception of security. Now that is kind of a genetic thing, that do your own research on it, and there's obviously multiple factors, but women typically traditionally go for men in terms of security. It's a large factor in terms of the decision making that goes along with selecting a mate. False perception of security. People have this idea that home ownership ties in with security. People have this false perception through social media that, oh, that guy's got a house, everything's sorted, he's great, men envy him, women want to be with him, it's a lovely house. Yeah, it's a 90% mortgage and there's a very good chance that it's going to capitulate in the next couple of years. You're going to be in negative equity and everything's going to be an absolute disaster. So, look, I could be wrong. I could be wrong about all of these things, but all I know is that there are 10 very, very logical points here as to why there may be a substantial reduction in demand and as a result a fall in house prices over the coming years. Yeah. If you think that anyone else can get some value out of this video, please share it. I'm not trying to scare people, I'm trying to be as informative as I can, and this is just what I perceive as being the reality which we're facing over the coming years. And of course you will not hear anything like this on the news or anywhere you typically watch TV. So yeah, look, hopefully this has been a benefit to you and it just gets you thinking. And I understand that I'm not offering you solutions here in terms of you need to make your own decisions here, but what I would recommend is have a hard look at your situation and be like, look, am I really overexposed here? Am I in a position where I could consolidate things a little in my life in terms of my mortgage? Maybe be slightly more modest, maybe be slightly more stoic, you know, maybe short-term sacrifice for long-term gain and security, and potentially start looking at a way of securing yourself in the more medium to long term, because if and when things do eventually turn in the other direction, it'll be too late. So you can't be reactive, you're going to have to be proactive. Although again, I could be wrong, but this is just food for thought, so hopefully it's of value to you. Yeah, that'll do. Oh, last thing, I'm actually doing my first podcast interview during the week, so I'll probably put that up next weekend. It'll be interesting. It's actually nothing to do with economics, I wouldn't think, so yeah, keep an eye out for that. But yeah, keep the faith. God bless. Much love.